Good morning, everybody. Welcome and happy Earth Day. And I could not be a sustainability director if I didn't wish you all a happy Earth Day today. Welcome to our show. It's going to be Tom and Tim today, and they're going to talk about the family office. And just so you all know, we are recording this morning's presentation, and you will get a copy of the recording as well as the slide deck a little later this morning or early this afternoon, depending on how long it takes to spool out of the system. And we all wish that you could put your questions that you have in the Q&A box. We have disabled chat to keep everything streamlined. So if you can use that Q&A box for any and all questions, and we will respond to them either through the Q&A box or live. So anytime you've got something pop up, put it on in there. And I think that is it for announcements. We're going to go ahead and pass the ball over to Tom.
Thank you, Jennifer. So do you have the slide up? I don't see it. So thank you, Jennifer. So my name's Tom Crotty, and I have worked the last 35 years. I've worked with family-owned businesses and families in their family-owned businesses as a CFO, Chief Operating Officer. So I spent a great deal of time helping families create wealth in that role. And in that process, I also was part of what is called an embedded family office, because invariably with the families I was working with, when you're going from a $5 million revenue level to over $100 million in revenue, you start creating great wealth for the families. And as part of that, I was also included in the embedded family office. So what we're going to cover today on the the last 8 years, just to finish with my introduction, the last 8 years I've spent in a wealth management context as a CFO for families in a multifamily office. So my role was being a CFO, COO, controller, depending on the role needed for families. What we're going to cover today is we're going to talk about family offices. It's an arcane business, and we're going to talk about what that looks like. We're going to talk about some of the tax advantages and the way you can actually structure a family office to take advantage of some tax savings. And we're going to provide some idea of why family offices exist in the first place. And so with that, maybe we can go to the first slide, the next slide. So one of the family offices are one of the fastest growing segments actually in the world, certainly in the United States, but in the world. It's an arcane business in the sense that you can see there's only 3,500 of them according to the Wealth Alliance, but they pack a powerful impact. They control $2.1 trillion in assets. They, even just the top 121, according to the Family Wealth Alliance, $140 billion in assets. I actually think these numbers are low because I don't think they cover things such as in Los Angeles, for instance, there's a business model called business management, business managers, and they manage the stars, the Hollywood stars, athletes, etc. And those don't talk about themselves as family offices, but essentially that's what they are. They're a multifamily office. So are we counting all the families that are in these multifamily offices or in these business management offices? I don't believe we're doing a good job counting it. The other reason is family offices are very, very secretive. They simply don't want to be known, actually. And one of the reasons is because they control $2.1 trillion in assets, and everybody in the world wants to work with them and wants to get wants to be involved with them. And so what we have is a very secretive group of enterprises, if you would, and at the same time, they have a huge impact in investing in real estate, how portfolios work. It's huge. And family offices could probably range from about $10 million in net worth and assets to certainly into the billions, One of the reasons they exist is because it's one of the least regulated vehicles for investing. Think about it. It's just my family wealth. I can invest anywhere I want. So I don't have the SEC looking at me. I don't have any of these other federal and state agencies looking at what I'm doing, because I'm a family office. I'm just managing our own assets. So it's a very interesting space. There's even hedge funds that are starting to, we're going to give back the money. We're going to become a family office. We're tired of all the oversight, if you would. So it's a fascinating space. And once you get into it, it's there's a lot there for sure. So what are family offices? What are they actually? And people want to know that. And they ask me oftentimes, well, define a family office. Well, here's the problem. If you know one family office, you know one family office. And why is that? Well, for instance, for one thing, families are quite different. What they're, they have unique personalities, they have unique interests, they have unique expertise. And so every family office has a little bit different flavor to it as to what they are, how they think about their investing, how they think about their office, whether they need one or don't need one. And based on what generation actually is now managing the wealth and controlling the wealth. First generations tend to be, they're scrappy. They've created the wealth. They've had to do everything in their businesses to drive it to success. And they tend to know where every dime, I have to say it, they tend to know where every dime is, even if they can't give it to you on a balance sheet. They know where their money is, and they know how they've created that money. Second generations, sometimes that second generation was not even in the family when the wealth was created. They're young kids, they're going through high school, and they didn't experience the wealth. And that wealth may have been made ultimately beyond, when they're out of the house. So when they do get the wealth, that generation may look at it quite differently than the first generation. And then of course, the third generation, there's all levels of generations. My experience is by the time you get to the fifth or sixth generation, people are used to having the wealth. They're comfortable in their skins about that wealth. And they seem to have become a little more genteel about it, if you would. But early on, wealth sounds like everybody would like it, but it can be stressful managing your wealth. And the other thing to understand, wealth in this country, studies have shown that something like 80% of wealth created in the country has been created through families and their family-owned businesses and owning them for over 20 years. In other words, growing, developing them, owning them, operating them. And in that, and I think actually the stat is 21.5 years or something like that on average owned, but it's over 20 years that they've created this wealth. We live kind of in a bubble here in the Bay Area because we have such huge wealth being created through the technology sector. IPOs make millionaires out of administrative assistants. I mean, it's just amazing the kind of wealth we've created. In the Bay Area, I think we have kind of a barbell that we have the technology companies and the wealth that has created. And then we have all the family, there's a huge level of family businesses and families that have served the technology world, and they have created wealth, whether it's the real estate magnates, whether it's the construction companies, office distribution. The wealth has been created serving the technology. So you have these two sources of wealth in our community. So if we go to the types of family offices, next slide, let's just talk a little bit about that, because when you ask what is a family office, there's so many flavors of it. Let's start with embedded family offices. Embedded family offices are where a family has been growing that company for over 20 years, and they start having an assistant start doing certain things for the family. The controller or the CFO starts managing some of the personal assets of the family, accounting for the assets. A lot of different things start going on in an embedded family office. The families get used to having not only the business being attended to, but also a lot of their own personal things being attended to. And so when I say that, we don't know how many offices there are, because those embedded family offices, I mean, how many companies are out there? How many families that have created, substantial wealth through their businesses? they have embedded family offices. That's why I say there's a lot more than 3,500. We just have to define what that actually means. Now, types of family offices. Yeah, oftentimes where the family office comes into play, when you start formalizing it and we start talking about it administratively, investment oriented, is because you've converted from your family business and created the wealth outside the business itself. And so when you start managing that wealth, it could be in real estate, it could be in portfolio assets, it could be in private equity investing or private equity-like investing. That's where you start talking about the different types of family offices. Sometimes it's strictly administrative. Hey, I need somebody to answer the phones. I need somebody to make plane reservations. I don't need anybody to do anything but that. Maybe write some checks. Do they even reconcile a bank account? We don't know. So it's just a very kind of simple, straightforward. I just need that kind of stuff done. Then you go to investment oriented family offices, and they could be on the complete opposite end of the scale. They don't have any administrative. I was engaging with quite frankly, north of $1 billion, in fact, several $1 billion. He was so successful in his investing, and he only wanted to deal with tech. He didn't care about the administrative side. When he needed money, he just moved some money into a bank account and he spent the money and moved more money in the bank account. Simply didn't care about any of the accounting or any. He just made great investments, and he just coached these high technology type folks into how to create successful technology companies. That's where he wanted to spend his time. That eventually gets to you because did you pay the insurance bill on one of your homes? Things start falling apart a little bit, and then you start thinking more about the administrative and accounting and that kind of thing. And so then you also have what I'll call the complete service type of family offices. And there you're doing administrative, you're doing all the accounting and bookkeeping and reporting and bill pay. You're controlling the investing, whether you're using outside investors to do that work, JP Morgan, Goldman Sachs for portfolio investing, or whether you're doing your own real estate investing. Those become kind of a complete service type of family office. Now, what you'll often hear is you'll hear single family offices and multifamily offices. In a single family office, you could have, it could be called a single family office, and it might just be an administrative family office. Maybe they're dealing with several generations of family, and all they do is pay everybody's bills or something. Or it could be an investment oriented, or it can be a complete service. So single family offices can fall into any of those categories. As far as a multifamily office goes, you tend to have all the services pretty much in one place. You can have a multifamily office that maybe just doesn't do the investing, but does all the other things. Remember, I mentioned that those business managers for the stars, they do everything. They'll do the investment management as well as all the paying the bills. Sometimes all they're doing is paying the bills. Sometimes they're doing the reporting. So that works within the family office as well. But with the multifamily office, you tend to want to bring all those services in one place. And the real issue, it comes down to what's the complexity you're dealing with? What have you created in terms of the wealth in your family world, if you would? And the more complex it is, the more sophisticated the family office you need to develop, you need to have, or you need to have a really sophisticated multifamily office that's serving your needs, that's covering all those bases. We often think of people who've created wealth as having, they've made it. This is great. The truth of the matter is, they find it stressful. How do you make sure you don't outlive your wealth? And most of us, I look at it go like, you give me $50 million, I'm not outliving that. But people get worried about that kind of thing. And so having the right kind of family office that deals with the right level of complexity is really, really important for families. Maybe we can go to the next slide, because oh, I thought we had a slide. Okay. So I want to key on this shirt sleeves, the shirt sleeves in 3 generations, the 70% failure to preserve and extend wealth beyond a 3rd generation. Those two go together. The colloquialism is shirt sleeves in 3 generations. Worldwide, this is a worldwide phenomenon that 70% of wealth is dissipated by the end of the 3rd generation. There are some studies that say it really is by the end of the 2nd generation. It just doesn't get to the 3rd generation, but we can safely say 70% does not get to through the 3rd generation. That's a staggering statistic, especially when you consider some of the wealth that's involved in these failures. Now, there's reasons for this. One is that sometimes wealth creators don't care if the wealth is extended beyond into the 3rd generation. I'll give you an example. I was talking to somebody I actually knew quite well, and he's one of those folks that support the technology. He does cabling for buildings and all that kind of stuff. He's probably worth north of $50 million. And so I was talking to him about, family offices and what we do and that kind of thing. And he just looked at me and he says, Tom, he said, my goal is not to leave $1 in my pocket when I die. He said, if I have more than $1, then I have not been successful. Now, but here's what I've done. He says, because I don't want to talk to attorneys. I don't want to talk to CPAs. I don't want to talk to anybody about my wealth. I don't talk to wealth managers. He said, what I've done is I've bought $10 million policies for each one of my kids, life insurance policies, all paid up. I don't have to worry about it again. When I die, they get the 10 million. What they do with that, I don't care, because I'm dead. So that's one level of attitude, right? And there's ways, and it takes a lot of different forms, by the way. But that was just one where he starkly laid it out for me. But let's take the group that really wants to preserve wealth, but fail. Well, there's several clear reasons why they do that. And these are studies that have been done longitudinally, worldwide. I mean, they just keep coming back with it. And 80% fail that want to. 80% fail because they don't prepare their heirs. They don't do a good job of succession planning. They don't have good corporate, or what I'll call family governance. They don't have family meetings where they talk out issues with the family. When you leave a family to its own devices and you just leave them a lot of money, what happens is family grievances show up really fast. You hit me in the head in the sandbox when I was 3 years old, and I'm still mad about that. I mean, when you have family meetings, sometimes it takes a number of meetings and communication and discussion around all these things to get past all of that, so that we can actually start talking about what is the purpose of our money? What is the purpose of the family with this wealth? What are we going to do as a family to preserve the wealth and continue that wealth? Because one of the tenets of holding wealth together over generations is that you decide you want to do that. Because as you get to the 2nd and 3rd and 4th generation, what happens? More and more families are living off of this potential wealth, or what might have been there to start with. So now the 15% of failure comes from what I'll call not managing your wealth, your reporting, understanding that you're outspending your wealth, all what I'll call the enterprise levels type of activities that need to go on, making sure you're not doubling down on risk in your portfolios, making sure that you're taking care of the assets and those kinds of things. And we'll talk a little bit more about that, because that's the place where Sensiba Sanfilippo plays. We play in that space. Here's the good news for attorneys, CPAs, and wealth managers. Only 5% of the failure to preserve wealth through generations is due to failure at the professional advice level. And so Tim on the call, it does a phenomenal job with his clients. And if they just listen to him and just follow advice, they're going to do well. but if you don't do well at the 5%, you still fail, right? I mean, but the good news is listen to your advisors, I guess, is the way I would summarize that. The very good news is that line that says 30% of families succeed. So if you take the best practices of the families that succeed, you do those things that I mentioned. For instance, you do have a form of family governance. You do plan on family succession, and you go through that process in a way that that's meaningful. And it is not. It's not a one-time event. I had one. Actually, it was a billionaire family matriarch that asked me, "Would you just do one family meeting for my family? I've got 5 daughters and a son, and they have no idea the wealth coming at them. They know they've lived well, but they have no idea, and they don't know anything about the trust. They don't know how to think about it. Would you just do one family meeting for me?" And by the way, this is like a third meeting I'm having with this family, and I just looked at her and I said, no, I won't do one family meeting. And I just left it at that. And she looked at me, and you can tell, she spent long lunches with me and all this kind of stuff. And finally I said, look, if you really want one family meeting, I will, but I'm going to put my CFO hat on. Don't do it. It's not worth the money. You need, if you're going to really accomplish the 3 or 4 things you said you want to accomplish with your family, you need to make this a priority, and it's going to take a number of meetings. It may take up to 3 years to get you where you need to be. So you can, and by the way, she bought into that. It was a joy to watch her family just develop over time, and they had to get past those initial meetings and communications. And then now they have investment committees. They're doing all the right things. They understand how their trusts work. They understand how the money's going to flow. They understand how the taxes are going to flow. So that's a best practice. And so another best practice is from one of the reasons family offices are created is, can you get favorable tax treatment? And Tim is going to talk about that a little bit later. And there are ways to do that. Now I'm going to talk about that failure rate. I'm going to make a recommendation. Read a book called Beer Money. Beer Money was written by Frances Stroh. She was of the Stroh beer family out of Detroit. And there may be many of you who don't know about the Stroh family, Stroh Beer Company, because it doesn't exist anymore. It got to the 3rd generation, and she was of the 3rd generation, and she had her cousins. Basically, they failed to get that Stroh business beyond that 3rd generation. They missed the light beer, the turn in light beer. They made investments that didn't work. They bought other beer companies that simply required so much investment to. They just had a strategy that simply didn't work. It failed. And she tells it from a very personalized perspective of been one of the 3rd generation, and now she's basically an artist and writing books and just making her way in the world, not having that advantage of the 2nd and some of the 3rd generation in that model. But it's a great book, good read, easy read, sometimes hard to see what happens. So let's go to the next slide. One of the reasons, so one question that comes up is when should you create a family office? And I would say that you want to create a family office when you're worried about your money, you're worried about the impact. So family offices are formed to try to solve that 70%. They're getting professionals that are working with the family to ensure that all the right things, but many of the right things are done. One of the ideas that we bring to the table from that 30% success is what I call moving from a mindset of a family business to the business of family. So when you create the business of family, that's a different mindset than the running the family business. Think about it from the wealth creator standpoint. They've been in their business over 20 years, oftentimes 30 and 40 years, and they know how to run that business. They know how to pull the levers when revenue starts falling. They know how to adjust expenses. They just know that business lock, stock, and barrel. But when they move to creating the business of family, that's not necessarily something they know well or understand well. And when we think of the business of family, I'd like to, if you can take a look at that, we're talking about efficient, and talk about the enterprise level stuff now. Efficient, timely bill pay, good information, timely information for making decisions. Internal controls, good right technology. What does that look like? That looks like a business. But the balance sheets of wealthy families tend to be way more complex, actually, than most small to medium-sized businesses where people have created their wealth. They move out into something where it gets more complex. And so, see how we're doing on time. So what we propose and what we're doing at Sensiba is we're bringing what we'll call just the professional good practice management to families. And so we're part of the family office structure. We may be the only piece that people are really using, or we may be part of a family office that has all that full, complete family office piece. And we're supplying either the accounting, the bookkeeping, bill pay. We love to bring the right technology for the level of complexity. What we find is oftentimes that simply does not, it's a huge mismatch. They're trying to get information, but they can't get it out of their system because their technology does not allow them to do that. So what I guess I'd like to leave you with is that there is that 30%, if you bring those practices to your families, you bring those practices to the family office, they can work. It can work. I just a simple couple stories. One, a family that owned their business for over 40 years, they sold it for $500 million. All the effort in going through the sale of that process, et cetera, nobody thought about what happens after you have the sale, and it was all for cash. So what happens after, the day after, what happens? Because you're just so busy running the business and then selling the business. Now the wealth management people, God bless them, are, they're right there. They're, because you're working with Goldman Sachs to sell that kind of company, and they're right there going to manage your money. But you know what the first question of the patriarch was? I have been getting paid next Friday on 2 times a month, and next Friday is that, how do I get paid next Friday? And that was his question. He's used to just being paid, never had to think about anything. Well, how do I get paid? How does that work? And you'd think, you have a lot of cash, I probably don't have to worry about that. But in his mind, what that question was way beyond whether he was getting a paycheck. The question was, how do I now manage my world? And so then we just jumped in and started, working with this family to help him basically structure a family office and start working on it. The other thing to point out is that, and then there's the other opposite where a fellow sold his company for $50-60 million. He didn't ask that question. He just kept spending his money. 8 years later, he's, I'm talking to him and he's saying, yeah, I think I have to get a job. And you're going like, you have to get a job? Well, he invested in kids' assets that failed. He invested in real estate. He just wasn't well managed, and he didn't manage his own world. And so you have these reasons why you should really think hard about how you manage that. Finally, I would say that from an internal control standpoint, it's amazing that there's in family offices a 27%, the last study I saw, malfeasance rate, fraud, malfeasance, and small businesses to medium-sized business is only 21%. And I think partially it's because we call it a family office, we think of people as family, and we don't believe that they would ever do anything. And guess what? It happens. So good internal controls, et cetera, need to be in place. Anyway, with that, I don't know if there's any, I see a Q&A. Let's just see if there's something there. Yes, okay, so Tim is gonna answer some questions. The key here though I wanna hand off is that, make sure you don't have taxes as a drag on the family wealth. and work with somebody like Tim. And Tim, I'm going to hand it over to you. You have some great ideas on how to make this this work for families.
All right, well, thank you, Tom. Thank you very much, and welcome. Good morning, everybody. So this is kind of my agenda to round out what Tom talked about. And I'm going to start with a tax perspective because I am a tax person, but I don't want to give the impression that these structures are formed just for tax. In fact, that could be problematic if that were the only motivation for these. So I think Tom has made a very good case for the business reason, and that certainly is what controls the the taxation of this and the respect that it is a actually operating business. We're going to review the lender case, which is a very interesting example. But I think the downside of studying a case like lender, and I was talking to Tom about this morning, is the question is not what is the ideal client for this structure. It really is what is the ideal structure for your client. So we're gonna go through the lender case, and I'm going to spend maybe a little more time than you want going through the details. And a lot of these things, I'm assuming, right? But I think it's a typical family dynamic that's worth going through. And then, time permitting, I'll go through some of the more esoteric things regarding how that structure worked, but I don't want to bog this discussion down with that detail. It's in the slides. If you have questions regarding those, I'm happy to answer those. Maybe after the seminar, you'll have my contact information. But just understand that we're focusing on what do these things look like from a structure perspective, and what are the tax advantages that we can get from them. Again, not tax motivated, but certainly get the benefits. So go to the next slide. So the kind of overarching theme here, and this is quite honestly why I got excited about family offices over the years, because from a tax perspective, I'm always looking for, how do we save taxes? Well, one of the old line tax deductions that people have been able to use is if I pay my investment manager to manage my stock portfolio, I get a deduction for that. I actually technically get a deduction for that under Section 212, but that deduction is limited to 2% of my adjusted gross income. And that's something that we've been used to for years. By the way, it's not just investment managers, it's also tax preparation fees. All right, so my fee, which was deductible as an itemized deduction on your 1040, subject 2% AGI limitation. Well, in comes the Tax Cuts and Jobs Act, 2017, and it took that concept and said, you know what? We're not going to make that deductible anymore. We're going to suspend the deductibility of investment expenses, investment fees, tax preparation fees, any other kind of fees that are associated with managing a passive portfolio. And we're going to suspend the deduction of that until 2026. Well, as I've done numerous seminars on what we can expect as far as tax law changes, I think this is what I refer to as low-hanging fruit. Any of these tax provisions that were either benefit provisions or non-benefit provisions of the TCJA that are set to expire in 2026, yeah, ain't going to happen. I think what's going to happen is that Congress is going to accelerate probably either the benefit provisions that were due to expire in 2026 or completely eliminate those altogether. I think this is one of those that is at risk. So I think I've driven the point home that if you're spending a lot of money on tax preparation and investment advice, if there was a structure that could allow those to then be deductible, that might be of interest, right? Now, go to the next slide. and we'll start to delve into the lender case. So lender case is very interesting. If you're familiar with the name lender and are a bagel eater, okay? So Lender's Bagels, Harry Lender founded, I think, the company back in 1927. It was called New York Bagel Bakery. Started out as garage with his two sons, Murray and Marvin. And this is a typical, American success story, right? As Tom pointed out, Dad was the one that, ground through it. I mean, he built this from scratch. And of course, in that generation, at that period of time, it was assumed that the sons, if capable, would take over the business. Really wasn't any question that the business would continue. The focus is how do we transfer the business to the next generation? When in fact, it is likely that that next generation doesn't want that business. And certainly when it gets to the third and fourth generations, they could care less. They don't want to bake bagels. So you can see that in the history of the Lender family, is that in around about, I think it was the 1960s, Harry, the father, transferred the business to Marvin and Murray. And it worked out. I mean, I think Marvin and Murray were very able, to build this into a multi-million-dollar operation. In fact, they sold Lender's Bagels to Kraft Foods in 1985. Now, I don't have the detail of what they sold that for, but apparently in 1996, Kraft ended up selling that to Kellogg for $455 million. Okay. So we got to think that there was, even if it was only worth half of what they, sold it to Kraft for. But, again, the vagaries of running a business, it turns out that 3 years after Kraft bought Lender's Bagels, after Kellogg acquired Kraft, they ended up selling for $275 million. So the value after 3 years just went down the tubes. So it does ring home, though, the fact that the focus of family succession planning shouldn't be how do we transfer the business. It should be how do we transfer the wealth generated from the business. And I think that Lender had some pretty sophisticated and very good advice in this regard. So I have put together, and you can go, Jennifer, probably to the slide here on the structure, because I think I'll go to the next one, because the picture paints 1,000 words. So I have greatly simplified this structure, although it wasn't that complicated when you boil it down. But you'll notice that ultimately the wealth of the family after the sale of the business rested in the hands of Murray, one of the sons, and Marvin, the other son. And then, of course, over the generations, we have, their kids and their kids' kids and their kids' kids, all descendants of Harry. And all the things that Tom talked about, all the different goals and objectives of all these different family members, very diverse. And you can imagine, this would have a great client for us, right, Tom? I mean, you've got family members who are each one's filing tax returns, each has, each one paying investment advisors to manage their individual stock portfolios. These tax returns could be very, very expensive. Well, again, Lender's focus was not to save taxes and make tax preparation investment fees deductible, but it was a benefit that derived from this. But their focus was primarily to serve the family and serve the needs of the individual families, but do that in a way that is not so complicated. So studying this structure, you can see that, and just a paragraph, and again, I've given you all the facts in the Lender case, but what it boiled down to was that the entire family wealth was basically divvied up into three entities, three partnerships, LLCs, and each of those entities represented a particular strategy with respect to risk and reward. This is how I interpreted the facts. So notice that in one tranche, the primary investments were private investments, maybe somewhat risky, but not so risky. The second one was public money, public companies, maybe mutual funds, that type of thing. Again, less risky, maybe less reward. And on the extreme side, you had the hedge fund, which really delved into the startup companies and other investments. And this structure, in my mind, allowed the lender family to customize each individual family member's portfolio. This is an individual portfolio of different funds that were managed by the lender management company. That's what I have that management triangle up there. And it ended up that Keith, who was probably maybe the favorite son, he was Marvin's son, maybe he had a knowledge and expertise in investment management and an interest in running the family business, obtained a majority interest in this management company. And that management company served to invest, oversee the operations of these three operating funds. Now, had the three operating funds by themselves just simply paid Keith, in this example, to manage those partnerships, we would run afoul of that section 67, which said that it's it's an investment management fee, section 212, non-deductible, okay? But because of this structure, lender was able to argue that the management company owned and operated by Keith, and by the way, Marvin had a little 1% interest in there as well, was actually operated as a trader business, such that Keith could go out, hire investment managers, hire CPAs, hire attorneys to help him manage these companies. And for that, he would be compensated, but not with a check, okay? Because again, if we were just to write these people a check, it would be non-deductible. It would be fees for service. So the structure that's unique under lender is that how did the management company get paid? And the management company gets paid by receiving an interest in the entities that it's managing, a 1% profits interest. Now, some of you might be familiar with that term. It's called a carried interest. It is actually a very hot topic in Congress. I mean, this is where, hedge fund managers, that's where they make their living. They don't get a check for doing the services. They get a piece of the action. And that's exactly what lender management company was getting, a piece of the action. Now let's go to the next slide. So what's interesting, Jennifer, can you go to the next slide? There we go. So I think what's interesting is that the facts in the lender case talk about the fact that they're providing individual, customized, one-on-one investment advisory services for all the family members. And they're doing that vis-a-vis their ownership through through those various entities. Again, something that looks very much like a non-deductible, at least until 2026, now becomes deductible because what's happening is the lender management company is providing those services as part of its service for servicing the entities. Now, of course, lender management, they had to prove that they were actually in a trader business, which means that they operated as a business. They had employees. Not all the employees were family members. And again, I don't want to delude you into saying that you need a family office with 5 employees. I mean, obviously, we were dealing with a family that had, at least by my guess, $200, maybe $300 million So that justified that expense. But this can be done at a 10 million. It can be done at a $40 million level, depending on the size of the wealth and the sophistication. And going back to that slide that I showed you earlier, you don't have to go back to it, Jennifer, but those triangles down at the bottom, which represented different risk entities of investments, you could add another box. It could be real estate investment. See, I'm a real estate guy, so I had to tie this back to real estate, right?
There we go. Yeah, absolutely.
But again, you know, sky's the limit. Back to my comment, the structure, we don't try to pigeonhole the client into the structure. We can use the structure to, you know, support the family. Now, there was a question that was chatted in earlier, and actually maybe, Jennifer, I am going to have you go back to that schematic again. Just go back up one slide. So understand that this simple structure here, where I say the Murray family, for instance, it's not one person. The Murray family is a bunch of people, right? It's nieces and nephews and sons and daughters. And each one of those has a unique goal and objective. And it's likely that 99% is split between trusts set up for the benefit of those individuals. It could be special needs trusts. It could be, I don't trust Junior with this money, so I want to control it. I mean, all of this structure is perfect for setting up another structure, I guess. So in between that 99% and that Murray family, there's probably a trust for the benefit of a grandchild. Or as somebody chatted in, I think it was Eva, you know, generation skipping. Yes, absolutely. I mean, there is a situation, obviously, where you could start to give, son doesn't need the money. Keith doesn't need all that wealth. So he starts to arrange his affairs in a way that he's anticipating grandchildren. Now that's where the generation skipping comes in. I mean, grandchildren maybe not even born yet. But the point is that this structure is very flexible to be able to allow for those kind of estate planning techniques. And, you know, estate planning is becoming very, very important today. As we know, Biden wants to reduce the unified credit amount. Right now, we have the ability to give away $11.7 million per person. That's 22 over 23 million per couple. That is scheduled to go away 2026 and go back to the pre-2017 threshold, which was 5 million adjusted for inflation. And Biden wants to reduce that even further. So, you know, families with wealth, significant wealth, and it could be basically wealth over $10 million, ought to be considering a structure similar to this to transfer wealth. So let's go to the next slide. One more slide. So again, the reason that this works from a trader business perspective, again, as I noted, we're not writing a check to lender management. We are allowing lender management to be compensated by a piece of the action, quite honestly. And interesting in the lender case, Keith not only performs services for the family-owned entities, but the entities themselves had investments in other non-family investments, for which, by the way, Keith was compensated, okay? Or lender management, I should say, was compensated. So the management company itself actually had another flow of income, not just from the family activity. And you can see that could happen, especially in say a real estate management portfolio. If Keith were a real estate professional and understood the complexities of real estate investment, some outside people might want to hire him for that, or the family could have invested in a tenancy and common interest in a real estate investment that Keith's expertise could benefit that. So again, it had all the trappings of this is an activity that is engaged in for profit, and that's why it's not surprising that that the tax case went in favor of the taxpayer, I think, because how could they conclude any otherwise? It basically was a trade or business, and those expenses are deductible. I know we've got 10 minutes to go here. I didn't want to delve into all the details, but just wanted to give some cautionary note that there are some, qualifiers in here. You do need to operate this management company as a trade or business. You have to be concerned with familial relationships. The fact that Keith was managing investments that he owned, right, vis-a-vis the family structure, did come into play with respect to the court's decision. However, because of the diversification and because of the number of family members, Keith's investment was relatively small. I think that I read one report where maybe he owned maybe 17%, okay, of all that. So the IRS couldn't necessarily say, well, you're just managing your own investments and therefore the investment expenses are non-deductible. So that was a factor. The other factor is we have to be concerned with carried interest and what's going on with carried interest. So the reason the structure worked well for Keith was when he was granted, or I should say the management company was granted this profits only interest, there wasn't an immediate taxation on the transfer of that. It was very easily done. You set up the entity and grant a 1% interest by the other entities to the management company. And as long as it's a profits only interest, then there is no immediate taxation until the profit is recognized with respect to that allocation. Now, lender made it even better by requiring the management company to actually put some skin in the game. So the management company itself didn't just get granted in most of these investments a profits interest. It actually maybe put 1 or 2% of capital into the investments to kind of secure that that whole scheme. So, but just something to be aware of is that the carried interest rules are changing and are dynamic. Congress doesn't like them. They don't like the fact that a hedge fund manager can get, a profits only interest, not pay any tax on that, and then years down the road, when there's a liquidity event, they get capital gain treatment, right, as a pass-through, and completely avoided self-employment tax. Well, yeah, okay. They're trying to change that, but right now, take advantage of the law that we have. So, okay. So, but again, tax consequences didn't necessarily wag the dog on this. It was really the, as Tom pointed out, the whole dynamics of preserving family wealth. So we are at the 10-minute mark, and Jennifer, you probably want to give me the hook, I guess, but do we have questions that have been chatted in, or?
Nothing that's come in yet. I was going to just let you keep going until something popped up.
Okay, well, I can certainly keep going. Although I think I may have said everything that I wanted to say here.
I think it's fair to say, Tim, that in all of these dynamics, Sensiba, our team, our professionals are prepared to serve the families. And so I always, even when I was consulting with family-owned businesses, I always thought about that from the perspective of the family first, and then the family business is just one of the drivers of their world. And so I think that's a key component of how Sensiba thinks about our clients and our families. So we're happy to respond or speak to any of these dynamics. and we're certainly happy to bring our expertise to you. So I guess I would leave with that, Tim.
Yeah. I guess the other thing that came to mind when you were talking about the arcane, the arcane business. I think a lot of our clients operate as family offices and don't even know it, as you pointed out.
It's fair.
So for years, I had a client who had hired a controller. Basically, she she had inherited about $40 million worth of wealth from her mother. She had no interest in necessarily operating real estate and wanted to put a team together of professionals. So we kind of had an ad hoc family office. I mean, we had an attorney, we had me, we had a real estate broker, investor, we had a an investment manager, and all of us would come together, 2 or 3 times a year and have a family meeting. And we would talk about the family's portfolio, the family dynamics. Oh my God. I mean, it's very fascinating, but, daughter getting married here, maybe this son getting a divorce, this one wants to pursue this. One has an interest in the real estate, the other one could care less. So just getting together, I think, with your advisor, I mean, even if you weren't under a formal structure, just having that mindset that you have a trusted advisor group. If you don't, you should. And that group should get together not only with mom and dad, but with the family, with the adult children, and talk about what does it mean to own this wealth. With great wealth comes great responsibility. And it's not only pressure, but it is responsibility. And one of the things that struck me about Lender when reading that case was that Murray and Marvin wanted to focus on charitable activities. They were at the point where they'd sold the business and it just freed them up to do the things that they wanted to do. It could very well be they never wanted to bake bagels, right? But they did because dad told them they should. So now they have the opportunity to, pass that wealth on, and their kids can enjoy what they want to enjoy, and I think that's really what it's all about. So anyway,
I think
if there's no other questions,
then
you have our contact information, and thank you for joining.
Yes, thank you. We'll go ahead and have this recording along with the slide deck to everyone by letter today. Hope you have a great Earth Day. Bye-bye.
Thanks, Jennifer. Thanks, Tim.
Thank you.